Hello everyone and welcome to Film Ladder. So in this video we are going to talk about why investing is so important. So let's just discuss a few things before we move on. So now what are the number of stock exchanges in India? Mostly people are only familiar with NSE and BSE, although there are many stock exchanges. So today in this video let's see what BSE and NSE is. They are the two of the most important stock exchanges in India and they both have their own indexes. For BSE we have Sensex and for NSE we have Nifty. So what exactly is Sensex? Sensex is an index of the top 30 companies of India. But what exactly does Sensex shows? It is a barometer for the market. There are so many companies which are trading on the stock exchange. How do we exactly know the market is performing? Is the market going in a bullish way or in a bearish way? So for that we have Sensex and Nifty. In Sensex, once we see that the Sensex is in green, it is in positive, we can say that the market is doing well. But if it is in negative, we can say that the market is not doing so well. So that is why we need Sensex and Nifty to see how the market is performing. As I said, it is a barometer for the market just to see how it is doing. Now just let's move on to the more important part. To understand why do we need to have these investment strategies in place? Why do we need a stock exchange? Why should we invest? So let's take an situation. So this data has been taken from macro trends and it provides the inflation rate over the years. Let's calculate the average inflation rate since 1979 and we will just inform in the later part of the video why we have taken 1979. So the average inflation rate from 1979 to 2018 will be calculated here. So for that we just simply put the average formula. We go to the inflation rate of 1979 and we take it till 2018. The average inflation rate over the years has been 7.86%. 7.87 to be precise. Now let's just take another example on the Excel itself. Suppose we had 100 rupees in 1979. The BSE started in 1986 with an assumption that on 1st April 1979, the base index was 100. So we assume that we had 100 rupees in 1979 that we invested in BSE. Now in 2019, the BSE is approximately 40,000. That simply means from 1979, if you would have invested 100 rupees in BSE, it now would have been 40,000. So what is the rate of interest that we earned? This rate of interest is also known as compounded annually growth rate. So how do we calculate that on Excel? Let's see that also. Today's value we divided by the previous or the initial value. Then we just raise to the power 1 divided by the number of years. So from 1979 to 2019 there have been 40 years. Just double close the bracket and subtract 1 from this. The rate of return that we get is 16%. So if in 1979 you would have invested 100 rupees in the market and it would have become 40,000 in 2019, the rate of return that you would have earned would be 16%. So let's just take the same example that you would have invested 100 rupees in a fixed deposit in a bank in 1979. Then the interest that you would have got would be 1597. Let's just approximate that a bit. 1597.45. For that we have used the compound interest formula. Principal multiplied 1 plus r%. The rate of return in the FD is assumed to be 7%. Raised to the power 40 for the number of years and then we add 100 again. So now let's just see the compounded annual growth rate, which will be very close to 7. Again the same formula. Current value divided by the previous value or the initial value, raised to the power 1 divided by the number of years, then we just close the brackets and subtract 1. We get this as 0.0717. So let's just approximate that again, which is exactly 0.07. Now, in the previous Excel, we saw that the inflation rate was 7.87. And in a bank, even if we just put all our investment in a fixed deposit, the rate of interest that we get is 7%. And when we talk about the savings bank, it is a lot less than that. So even if we put our money in a bank and we say that we have made an investment, we have made a fixed deposit, we are even losing the power of money because the inflation rate is 7.87%, but the interest rate in the bank is 0.07. Whereas over the year, the compounded annual growth rate in the stock market has been 16%. So that is the need for investments in the stock market. This compounded annual growth rate shows that over the years, the market has given us 16%. That means that at some point of time, the market would have given us 8%, some point it would have given us 24%, at some point, even in the negative, like 2008 and so on. So, but in the long run, it has given us 16% returns continuously. Now the decision is pretty clear between a bank and a stock market. The investments in the stock market is very important for your money to grow and for you to become rich. In the next video, we are going to talk about how should we invest, how should we go through the company's statements, the ratios, and many technical indicators as well to understand how to pick up companies and how to invest, not only to make money but to make wealth. Thank you for watching this video.